There's a brown envelope that turns up on the mat some mornings, and you know before you've even picked it up. Something about the weight of it. The little window on the front where your name sits, printed rather than handwritten, official in that particular way, only a government letter manages to be. This August, a lot of those envelopes are going to be from HMRC. Starting on the 12th, something like 1.8 million of these letters will begin landing on doormats up and down the country. They're called Simple Assessment Letters, and if you want the official name for the form inside, it's a PA 302. Not that the name matters much when you're standing at the kitchen table turning it over in your hands, wondering whether to open it there and then or wait until you've had your tea. What it means, in plain terms, is that HMRC believes you owe some tax from the last financial year, the 2025 to 2026 year, that wasn't collected automatically. Not through your tax code, not through a self-assessment return. It simply wasn't taken at source, the way tax usually is when you're employed and it comes off before you ever see the money land in your account. For a lot of people, especially those who've never filled in a tax form in their life, this comes as a genuine surprise. And it's worth pausing on why that surprise happens, rather than just accepting it as one of those unexplained things government does. Think back to how tax worked during a working life. Wages came in, tax already taken out. Simple, invisible really, unless you went looking for the payslip and read the small print. You didn't think about tax because someone else was thinking about it for you. Every single month, automatically, before the money ever reached your bank. Retirement doesn't always work that way. State pension, private pension, a bit of interest on some savings you tucked away for a rainy day, maybe some dividends from a small investment you made years ago and mostly forgot about. None of that necessarily gets taxed automatically the way wages did. Interest builds quietly in a savings account. A dividend arrives twice a year and gets absorbed into everyday spending without much thought. State pension, in particular, is one of those odd corners of the system where tax isn't deducted at the point of payment, even though the income itself can be taxable depending on what else is coming in alongside it. So, it builds up, quietly, until HMRC catches up with it, usually a good while after the tax year in question has already ended. HMRC catching up. It isn't a new tax. It isn't a penalty, because the shape of a letter like this, the crest, the formal language, the reference number in the corner, can make it feel like something has gone wrong, like you've been caught out somehow. You haven't. Simple assessment has existed for years as a routine part of how HMRC deals with tax that can't be quietly folded into a tax code. This year, they've simply confirmed the rollout for the last tax year's figures, and the letters are on their way to those affected. If you're the sort of person who still prefers to pay in cash or write a check, HMRC is nudging people towards digital payment through their app or via bank transfer. That doesn't mean cash or check options vanish entirely, but it does mean the path of least resistance now runs through a banking app or a card payment, rather than a walk to the post office with an envelope of notes tucked inside your coat. For some, that's no trouble at all. For others, it's an adjustment. Perhaps you've never used a banking app in your life, and the idea of moving several £100s through a phone screen feels like a step too far. That's a fair thing to feel. And it's worth knowing in advance that check and in-person bank payment options do still exist, even if they're not the ones HMRC leads with. Picture the moment itself for a second. You've opened the letter, reading glasses on, because the print always seems smaller than it needs to be. You're at the table, maybe with a cup of tea gone lukewarm beside you, and there's a number on the page. Perhaps it's a modest amount. Perhaps it's more than you expected. Generally speaking, it tends to be sums nudging past £3,000, where this kind of collection method becomes necessary in the first place, though every letter carries its own figure and its own explanation. So there's no single amount that applies to everyone. That's one thing HMRC has been fairly clear about, at least. The letter itself should explain exactly how much is owed and why. Interest on savings that built up somewhere over the year. Dividends from shares held quietly in the background. A bit of income from somewhere on the side that never got taxed at the time. Or, as we've said, pension income that slipped through the usual net because nobody was there to deduct it as it arrived. You don't need to fill out a tax return for this. That bears repeating because it's one of the more common worries people carry when a letter like this arrives. People see anything from HMRC and assume it means hours at the kitchen table with a full self-assessment form in front of them, box after box, a deadline looming somewhere in the new year. It doesn't work that way here. This is simpler than that, by design. And that's rather the point of the whole simple assessment process. The letter tells you the amount. You pay it. There isn't a form underneath it waiting to be filled in. The deadline for most people will be the 31st of January 2027, unless your particular letter states something different. So there's time. Not endless time, but enough to sit with it properly. Check the figures against your own records, perhaps have a conversation with someone you trust about it, and work out how you'll settle it without rushing, which raises a fair question, and probably the one most people ask first. What if the numbers don't look right to you? What if you look at your own bank statements, your own paperwork, and the figure on the letter doesn't quite match what you'd have calculated yourself sitting at the table with a pen and a calculator? That's a completely reasonable thing to want to check. HMRC's guidance points people towards their online personal tax account, or the gov.uk Simple Assessment Guidance, written specifically for pensioners, as the places to look further into the detail behind the number. There's also a quieter question sitting underneath all of this. One a lot of people won't say out loud but will wonder to themselves at the kitchen table, glancing at the letter again just to be sure. Is this actually real? Genuine HMRC letters arrive by post, or they show up in your secure online personal tax account, nowhere else. It's worth knowing that clearly, because letters like this, formal, official-looking, mentioning specific sums of money, tend to be exactly the kind of thing that scammers try to imitate. If a text message or a phone call turns up out of nowhere, asking you to pay urgently, quoting a similar sort of figure, that's not how the genuine process works. The real letter, the one through your door or waiting quietly in your online account, is the one to trust. Anything arriving by text demanding immediate payment should be treated with suspicion, not urgency. Then there's the practical weight of it, the part that sits with you longer than the letter itself does. A bill like this doesn't exist in isolation. It sits alongside everything else. The heating, especially as the year turns colder, the weekly shop, whatever else needs paying that month, the ordinary rhythm of bills that never quite stops. If the amount is a few £1,000s, that's not nothing against a pension income, and it's fair to feel that pinch when you're working out where it fits against your usual outgoings. Perhaps looking again at the shopping list and wondering where a bit of slack might come from. Some people manage that by paying it in one go, straight from a bank transfer, treating it like any other bill that's landed slightly bigger than expected. Others find that harder and wonder whether there's room to spread the payment out over several months instead. That's worth checking directly with HMRC if it applies to your circumstances, since the letter itself, or the guidance linked to it, should say more about what arrangements are possible for those who need them. What's less clear, and it's honest to say so rather than pretend otherwise, is how this interacts with certain benefits. Pension credit, attendance allowance. The available information doesn't spell out whether these are factored into the calculations behind these letters, or whether recipients of those particular benefits are treated any differently from anyone else receiving one. If that applies to your situation, it's one of those areas where checking directly, rather than assuming either way, is probably the safer path. Guessing here could mean either unnecessary worry or a missed conversation worth having. There's a kind of quiet unfairness some people will feel here, and it's worth naming rather than smoothing over with reassurance alone. You didn't ask for this money to go untaxed in the first place. It simply did, because the system that usually handles tax automatically doesn't always reach every corner of a pension income built from several different sources over the years. Nobody sent a warning at the time it was happening. The letter, in a sense, is the first anyone hears of it, arriving well after the tax year in question has already closed. And yet the process itself is designed to be about as gentle as a tax demand can reasonably be. No return to fill in, a clear figure stated plainly, a clear reason given alongside it, months before payment is actually due. It's not nothing, receiving a letter like this through the post, but it also isn't the beginning of some long, drawn-out dealing with the taxman that some might fear the moment they see the envelope on the mat. If there's a single practical thing worth doing when one of these letters arrives, it's this. Don't put it in the drawer and forget about it, however tempting that might feel in the moment. HMRC themselves are fairly direct on this point. These aren't letters to set aside for another day. Read it properly, ideally somewhere quiet with good light. Check the figure against what you know of your own income, and if anything looks unfamiliar or doesn't quite add up, get in touch to ask, rather than guess and hope it sorts itself out. It's also worth remembering, in amongst all this, that this isn't something happening to you alone. 1.8 million letters is a great many kitchen tables up and down the country, a great many people doing exactly what you might be doing right now, turning an envelope over, wondering what it means before they've even opened it, perhaps ringing a son or daughter afterwards just to talk it through. There's a kind of quiet reassurance in that, even if it doesn't make the number on the page any smaller or any less real. Nobody enjoys an unexpected bill. Least of all, one wrapped in official language, arriving without any real warning beforehand, landing on an otherwise ordinary Tuesday alongside the usual post. But this one, at least, comes with an explanation attached, a reasonable stretch of time to deal with it properly, and a process that doesn't ask much more of you than reading it carefully, checking it against your own records, and knowing where to go if you need to pay, or if you need to ask a question first. So, if the post brings one of these letters to your door sometime after the 12th of August, there's no need for alarm, and certainly no need to panic at the sight of the envelope. Make the tea. Sit down properly with it. Glasses on, somewhere you can give it your full attention. Read what it says, check it carefully against what you know of your own affairs, and take it from there, one step at a time, the way most things worth doing properly tend to get done.